I'm going to talk about QBE today, and Anthony's explained that QBE hasn't been the most successful stock in the share market for the last 5 years. It's been one of the worst performing stocks. I've got a chart of the problem. So, many stocks peaked around November 07. This is when the market. Does this point? Does that red dot work? Oh. There we are. Anyway, you can see that the market share price peaked at, it was around over $35, and the share price today is $11.16, and it's been as low as $10 this year. And many companies obviously did very badly in the GFC, but many of them are recovered. Like Commonwealth Bank got down to $25, $26. It's now around over $80. And QBE hasn't recovered, it's got worse. And I can tell you the whole corporate story, but it almost comes down to a sort of a drama of people. It's almost a Shakespearean tragedy. With Frank O'Halloran was the key architect of this company. He successfully undertook over 100 acquisitions and did a fantastic job from the early 1970s through to this $35 price. And it was he built QBE into one of the largest insurance companies anywhere in the world. And they even bought a very large Lloyd's syndicate in 1999, and that ultimately proved to be a successful acquisition for them. But then a number of things started to go wrong, and really started when they wanted to buy some very large acquisitions in the United States, and they were huge acquisitions, much bigger than any ones they'd done in the past, and it was a really very bold move, but it was difficult for them to afford the acquisitions, and they had to take on a lot of debt. So previously, prior to the acquisitions in those big US acquisitions, which were done around this time, the company really had only accumulated about $1 billion of net debt. And by the time he'd done a number of these US acquisitions, the debt was about $6 billion. And then what happened was that the acquisitions didn't really perform very well. So firstly, we had too much debt. Secondly, the acquisitions were all predicated on goodwill. They weren't hard assets. And thirdly, what happened was that interest rates started to decline globally because of the GFC. You may be aware that an insurance company often makes more than half its profit from the interest income on reserves. And that's the famous sort of Warren Buffett principle of a free float, which he talks about in his books. Now, the very low interest rates are really anathema to a successful insurance operation. And so QBE suffered again from that. The other thing that happened after the GFC, if you remember, is the Australian dollar went through the roof. So it went to, from, I think it was close to 50 cents at one point, and went up towards $1, and then actually exceeded US dollar above parity. And this was after QBE had spent all this money on these US acquisitions. So that meant that the value of the acquisitions in Australian dollar terms were much less. And that's been another problem. So if you combine all that, we had all this sort of recipe for pressure on QBE, and the board really wasn't on top of the job. In fact, there was no one, in my opinion, there was no one on the board that actually understood insurance and what Frank was doing. They weren't insurance sophisticated, and they were really quite negligent, almost suable in a sense. Since then, we've obviously had a real makeover of QBE, and I won't go into all the details, but we've got a number of slides. We'll skip over in the interest of brevity, Anthony. You'll be happy to know. But QBE's being remediated, in my opinion. We've got a new board, a new management team. They're working on improving the balance sheet. They're trying to get the gearing down, the debt down. They've reviewed all the goodwill, and they've written off a lot. We've had a number of losses. In fact, if I just go through to and this just shows how the profits have really declined over the period. Now, the insurance margins actually peaked at close to 25%, and they were really unsustainable. And the profits down here, these ones were these two were probably overstated, and they really should have been closer to this. We've got a new management team who's starting to give better reporting, and this is a probably more representative percentage. This is about 7.5% margin. And the company's indicated that going forward, they think they could do a base case of at least 10%. We think over time they can improve that. In fact, we've got a forecast, which I'll skip through to. So we think the earnings can, this is where we think they'll go, these light blue lines. And based on just this base case, we think the shares are about 20% undervalued at the moment. We think there's a good case for a turnaround in QBE. I can talk more to you over a drink, but that's one stock that hasn't gone completely through the roof, is relatively undervalued, and represents a good contrarian investment opportunity. It's not completely guaranteed, nothing in this life is apart from death and taxes, but we think on the balance of probabilities, it's got much more upside than downside compared to most other stocks. Thank you. Okay.